some things that listeners should really be thinking about before they actually start putting these strategies into action?
Well, one of the most important things to understand is the difference between intrinsic value and extrinsic value.
Okay, break that down for me. I've heard those terms before, but I'm not sure I totally get the difference.
Sure. So think of intrinsic value as like the inherent worth of an option if you were to exercise it right now.
Okay.
It's basically the difference between the strike price and the current market price of whatever asset that option is tied to.
So, for example, if I have a call option and the strike price is, say, $50,
Okay.
and the stock is currently trading at $60,
Mm-hmm.
the intrinsic value is $10.
You got it.
Okay.
Now, extrinsic value, that's a little bit trickier. It represents what we call the time value of the option.
Okay.
It's basically that premium that you pay above and beyond the intrinsic value.
Gotcha.
And it takes into account the possibility that the stock price could move even further in your favor before the option expires.
So even if an option doesn't have intrinsic value, like if the strike price is way off from the current market price, it still has some value because there's still time for things to change.
Exactly. And that's why, options that have longer expiration dates, they tend to have higher extrinsic value
Makes sense.
because there's just more time for those price swings.
Okay, so how do these concepts, like how do they actually come into play with the strategies that we were talking about earlier?
All right, well, let's think about those protective puts for a second.
Mm-hmm.
As the expiration date gets closer and closer,
Mm-hmm.
the extrinsic value of that option, it starts to decay.
Okay.
So if the market doesn't drop significantly before that option expires, you could end up losing some or even all of that premium that you paid.
So the timing of when I buy the put is actually really important.
Very important, yeah.
I need to be thinking about like how long I think it might take for the market to drop.
Exactly. Yeah, you got to kind of weigh the cost of the option against how long you need that coverage for.
Okay.
It's a balancing act.
Makes sense. What about put spreads?
Yeah.
How does all this affect those?
Well, remember, with a put spread, you're selling one put option at a lower strike price to help offset the cost of buying that higher priced put.
Right.
But that also limits your potential profit, right?
Mhm.
If the market really takes a nosedive. And as with any option, that extrinsic value of both of those options, it decays as you get closer to expiration,
Okay.
which can impact your potential profit.
So it sounds like managing those strike prices and the timing is super important with this particular strategy.
Absolutely, yeah.
Yeah.
And then with those long straddles and strangles, the level of implied volatility in the market, that can really make or break your success.
You mean like how much the market's expecting the price to swing up or down?
Exactly. High implied volatility, that usually means you're going to be paying higher premiums for those options, which can, eat into your profits.
So even if I predict a big move correctly, if those options were super expensive, I might not actually make that much money.
Right. Exactly. It's all part of the calculation.
Okay. Now, the collar strategy you're saying earlier, it's a more balanced approach.
It is, yeah. It's designed to kind of limit both your potential losses and your potential gains.
I'm basically creating like a comfort zone for myself.
You could say that, yeah.
Okay.
You're limiting your downside, but you're also limiting your upside.
Right.
It's a good choice for investors who, want to participate in some of that upside potential, but they also want to mitigate that downside risk.
Okay, makes sense. And then finally, what about inverse ETFs? Anything specific to keep in mind about their value?
Yeah, one thing to remember about inverse ETFs is that they use what's called daily compounding,
Okay.
which means that over longer periods of time, their returns can actually drift away from the underlying index that they're tracking.
Ah, okay. So that's why you were saying earlier that they're really best suited for short-term trading.
Exactly.
Yeah.
Yep. So, if you're thinking that there's going to be a correction in the next few weeks or months, inverse ETFs might be worth considering.
Okay.
But if you're thinking longer term, probably not the best fit.
Gotcha.
And it's also important to remember that they can be very volatile.
Right.
So, you really got to understand the risks involved.
Okay, so it sounds like the big takeaway here is that, options and inverse ETFs, they can be really powerful ways to manage risk and even profit from a market downturn.